Well, let me finish out where I do see some great opportunities to help provide your clients with that clarity and direction to help them take action during this time period. And if we're going to talk about where opportunities exist, it's imperative that we understand the environment in which we're investing in. And it's important to understand or recall that we've added $2 trillion of stimulus into the system over the past several years. That we know the Fed was flooding dollars into the system all the way up through June of this past year. And that's why we at the Washington Update made the call last December, say, hey, be careful of the equity markets this summer and fall. It's the first time our economy stood on its own 2 feet in 3 years. So we don't really know where those numbers are going to fall in. And I think we've seen that come true as well. But what we should also expect, what are the ramifications of investing in a high federal deficit environment? We should expect slower U.S. growth and a declining U.S. dollar. We should expect higher inflation and higher interest rates. That's what you would expect to see in a deficit environment. But that's not me saying that. That's actually Chairman Bernanke testifying before Senate when the senators asked him, what should we expect about investing in this high deficit environment? Now, I will take ownership over this last bullet point. I think it's imperative as your clients' financial advisors. For any of your clients who are, say, 55 years and older, I think they can fully anticipate getting their full entitlement programs as they have come to expect. But for your younger high-income clients, you need to start preparing them that their entitlement scenario, their package, if you will, Medicare, Medicaid, and Social Security may look very different than it did for their parents. So I think you need to start thinking about including that. But in addition to that, I think there are some great opportunities within the investment space. I think emerging markets still make a lot of sense. We know the U.S. investor is still dramatically underrepresented in international investing, and that goes doubly true for emerging markets. But another way to play that, if your clients aren't really willing to step out there into the emerging markets, would be large U.S. multinationals that have significant exposure to that emerging market consumer. Because just like we can't deny the impact of the demographic changes in the United States, we also can't deny the demographic changes in the emerging markets. This burgeoning middle class that's growing in the emerging markets, we know as they move past sustenance and into consumer spending, they want the consumer goods that these companies either manufacture or certainly distribute. So another great way to play that. But I think emerging market debt as a complement to U.S. debt strategy also makes a lot of sense. Now, this emerging market debt I'm talking about is national debt denominated in local currencies. If you believe, as we do, that we should expect the dollar to continue to decline, that gives you that kicker effect when you repatriate those currencies back into the U.S. dollar. And then finally, any investment that either hedges or takes advantage of rising interest rates, rising inflationary environment. And clearly, I've made the case that we believe taxes are going up, so the typical strategies that we would look at in that environment is watching for those concentrated stock positions. And I know you've talked to those clients until you're blue in the face trying to get them to liquidate them. But I just encourage you, don't get off that accelerator. Keep that discussion in front of those clients, because I do not believe capital gains will be as attractive down the road as it is today. Certainly if they're high income, high net worth clients. Municipal bonds in a rising tax rate environment, obviously municipal bonds are going to look more and more attractive as those yields increase, as well as gifting strategies. If you believe, like we do, that estate taxes will likely not be as generous moving forward, gifting strategies makes a lot of sense as well. Now, the interesting thing about the gifting, I do want to take a little side note at this point, because a lot of people are saying, well, Jeff, if I convince my client to gift $5 million, and then next year the unified credit goes down to $1 million, will they claw back that $4 million, right? You probably have heard that question come up. I will tell you, there is a very, very small minority view of tax professionals that think that that is possible. But there's 100% consensus that the appreciation on all $5 million would remain outside the taxable estate. So even if it did happen, again, we do not believe it will, but even if it did happen, your clients are still benefited by gifting today and getting those monies outside their taxable.